Hey everybody, I'm Joe Quartucci,
I'm Arpit Sharma.
and we are here to bring you our third episode of but wait, it's our fourth episode, isn't it?
Fourth episode, yeah.
Fourth episode of Bull
Yeah.
Bear Brief. Today we are going to be covering the market's performance from the week of April 13th to the 17th. We've got
Mhm.
an update for you, an unfortunate one. The whole kind of fun part of what we do, which is to kind of forecast the following week, and me and Arpit have a friendly competition about who is right and who is wrong. Compliance said, no mas. We can't do that anymore. They say that is potentially giving you advice. So I will take this opportunity to say what I say almost every week on the show, which is you should not be listening to the show and then implementing advice from the show. This show is for Arpit and I to talk about what happened the previous week, what's moving markets. If you're making decisions about your financial planning, you need to sit down with your financial planner, your tax preparer, your tax advisor, and make decisions based off of what they tell you. They know way more about your situation than we do. This show is for entertainment and also, we think, for education. There's a couple of people on this podcast, Arpit and myself, who have pretty good experience, pretty good intellectual ability, good training, but that is not the substitute for somebody who knows your situation is giving you advice. So that's my nod to compliance. I do think it's kind of not cool that we don't get to say that. But I also understand that because we are registered individuals, that people who we are registered with probably don't want us to go too far down that road. But anyway, like I said, we're here to talk about the week of April 13th and 17th. So Arpit, what you got on that? Tell me what you got.
Yeah, it was a really green week. I know we're not keeping track anymore, but we were both right last time around. We were both bullish. Markets are up around 4.5%. Most of this was on the growth side, with tech doing really, really good. Nasdaq up around almost 7. Large growth up around 6.7% as well. Dow clawing its way back up to 50,000, almost. Not there yet, but almost there. Around 3.2%. Small caps did pretty good as well, 5.5, and then value not doing that bad as well, 2.4%. So really green week overall.
Big move for Nasdaq,
Mhm.
6.83% in a single week. A lot of people have noticed that if you look, say, at the last 25 years, Nasdaq has dramatically outperformed the S&P 500, so
Mhm.
you would expect it to do better in a week of pure greens. Let's unpackage the cause a little bit if we can. Obviously, the markets were betting that the piece would hold.
Yeah.
There's been a lot of what we would call bullish tweeting or truthing, as we would call it, from President Trump. And I think the markets got, pretty happy about that. And then on Friday, Iran announced that the strait was going to open. And that's when we saw the rally really take even additional steam. S&P set a new record high. Uh, of course, now it's Sunday. We're going to be bringing this show to you on Monday. And it looks to be that piece may have been kind of fragile. So do you have any comments or thoughts on that?
Yeah, no, I mean, you summarized it pretty well. It's all again based on the hopes that there is a extension to peace deals and the peace deals become, longer lasting, right?
Yeah.
Uh, for the earlier talks of the peace deal, it kind of was just between the U.S., Israel, and Iran, and now it looks like Israel included Lebanon in there finally. They agreed to include Lebanon, and then again we had Don Zhu coming out with the blockade of a blockade, and then Iran seems to come out and said that, hey,
Donzu.
okay, we're
Is
gonna
that is
let
that
you.
like a is that like you're saying he's like Sun
Sun
Tzu,
Tzu,
the
the
art
art
of
of
war?
war, yeah. Art
How do
of
you
war.
break a blockade? We blockade your blockade.
That's pretty much what happened, and then we were talking about it earlier today, that, hey, we looks like there's still the blockade is still in place, and somehow, because we ended up, shooting an Iranian ship out the water almost and boarding it and taking it,
Yeah,
right?
yeah. I
So,
don't, I don't, I don't understand how that's gonna hold with us firing at each other. But I mean, at this point, my conjecture, for what it's worth, is that I don't think President Trump wants the conflicts to continue.
yeah,
Sometimes it's harder to put that genie back in the bottle once it's out, and that kind of seems to be the case. There's probably a lot we don't know. But if I
yeah,
had to bet, and again, this is not a bullish or bearish indicator, but if I had a bet, I think that we're probably heading towards some sort of peace because, again, in order for there to be a war, both sides have to want that to happen. And I don't think it's good for Iran to continue to be bombed. I don't think it's good for them to be able to be blockaded. And we've
Mhm.
proven that for the United States, for this conflict to continue, it's really terrible for our energy markets. It's inflationary. It's all these things. I mean, there's going to be, in my opinion, there's going to be damage from this that lasts 6 months to a year anyway. And I don't think President Trump and nor most Americans have the patience to grind out another war in the Middle East. That is what would be required to actually reopen the Strait of Hormuz with military force. Because is that kind of how you see it, or do you see it another way?
No, I see it the same way. Again, one of the big things, at least Trump has somewhat going on him for in general the American economy here. We've been talking about this thing, the K-shaped economy, right? But for the most part, you still had a little bit bend to that K, and that bend was upper middle class, right? They were still somewhat fine, but we were starting to see the beginnings of the inflationary causes of the tariffs, and now you have this war coming in. That's going to greatly, temporarily increase oil prices, which is again going to feed into food prices, which would then feed into everything else, which is again more inflation. That starts to impact heavily the high upper middle class, and now you're not really having just this broad lower class getting hit. Now you're having almost everybody except really the richest of the rich, right? So I think if Trump wants this, the economy not to kind of turn over here, they're gonna have to figure out some way of getting some peace and getting the oil out there fairly fast.
I have a question, and I'm curious your conjecture on it. Oil finished the week down to $85, which is
Yeah.
still really elevated. It's not super
Uh-huh.
elevated, but it's more than where we were. $20 more than where we were when the war began. I kind of think I know the answer to this question, but um, with oil having been above $100 or near $100 for roughly 6 weeks, that to me could be kind of eaten by some companies and maybe not passed along to the consumer. Um, 85 is still going to be higher, so I would expect there to still be some pain. And it's also been my experience now, 26 years of paying attention to this stuff. It's been my experience that it's been my experience that companies often don't miss an opportunity to increase prices. So any input cost to them that they can pass along to consumers, they typically do
Yeah.
it. And then it's also been my experience that they don't usually come back down. So I guess a 6 week spike to 100, let's suppose we end up settling in around 80, $85. Do you still expect that to put inflationary pressure on the economy? And then what will that do? And again, in your kind of opinion, to earnings, say, over the next year for for companies not related to tech. I mean, tech's gonna have to eat
Yeah.
some of that too, but they have way more pricing power than, some of the retailers and things like that.
Well, I definitely see this being, that is the big question: is that how long is this going to be inflationary? Is it going to be, a forever change? And inflation, it's pretty interesting when you look at the measurements of it. You're looking at the month over month one, right? That's kind of forecasted to be built in and kind of stuck there, right? So when you're looking at your next month's inflation, it's already including all the other past inflation readings, right? So the assumption is that those prices aren't going to go back down for a while, if at all.
Mm,
Right? Your inflation readings are rarely negative, right?
yeah,
So they're usually positive, whether or not they're positive by a lot or very little. That's kind of the main determination, right? So the prices themselves tend to be stuck pretty well. Now, whether or not these prices are going to stay, like, or the oil prices, the impact of the high oil prices is going to stay there for a while. That's more of a, that's entirely dependent on how long this war is. Though, for a few weeks, there's gonna be, moderate level impact, so you gotta take into account that these guys, a lot of the big chains, a lot of the big oil companies, a lot of the big, agricultural businesses, they do a lot of futures, right? And so they kinda keep their prices relatively stable, right? This is the reason they do futures, right? And larger oil companies don't want to keep pricing their oil at whatever is this rapid amount, right? They want to keep it relatively maintained, and those futures are increasing, right? The future prices probably around where we are now, right? And so you're going to have this built-in, baked-in higher oil for the next few weeks. Not going to be at around $100, right? You're not going to be around there. You're going to be around the $80, $70 limit, which is not nice for a consumer, but it's also not. I'd say it's not the most backbreaking level,
yeah.
right? And it's also really good
Well,
for the companies.
I'll push back a little on that.
Mhm.
I'd be surprised to see it in the 70s. I think 85 is probably the new short-term low, just because there's still uncertainty. And I mean, I one of the things that I've been paying attention to throughout the conflict has been just the traffic, because you've heard or you've seen tweets or truths that the strait is open, or even when Iran said it was going to be open on Friday, the traffic never really picked back up. And this is where I think there are some things we don't know. If there are mines that were relayed, they don't just disappear. That somebody has to go pick them up. And so there's the traffic has not been robust. And an interesting thing that I saw, and I'm don't know that this is accurate because I'm not an expert on the area, but the traffic has been routed a different direction where there are no mines, and so the the most ships that have gone through the strait in a single day has been 30 since the
Mm,
conflict started. Before the conflict started, there was an average of 115 per day going through the strait, and so I mean, I think
a huge drop off.
to think we can get back down to $70, in the next 2 weeks, there would have to be some substantial movement, where, maybe Iran or Iran and the United States do some sort of joint press conference together, because otherwise I just can't see there being this is I think I texted you on Friday, which is how many more head fakes are we gonna have? Like, that the market's just gonna keep buying, "Oh, there's peace," but there really is not peace. I mean, at some point, you're gonna start losing faith, you would think, in that process, and, like, even you and I were pontificating at the start of the show about how we think that there's gonna be peace because that's what's in everybody's best interest, but you are playing a dangerous game over there when you've got, you know, what if the wrong ship gets sunk, or what if too many of our
Mm.
sailors get killed, or something happens that pisses Iran off and they end up firing, drones again at their neighbors or Israel. I mean, it wouldn't be very hard for us to be wrong about that peace and for it to turn back into a major conflict again. So I guess that's where I'm a little, I guess, bearish to see oil prices drop into the 70s. Because from a supply and demand perspective, you've taken supply offline for it will be a period of time before it can be back to normal. Am I wrong about that?
No, no, you're not wrong on that one. It's more
But
so
I know markets are forward looking, so that's
yeah.
the part where I do get a little bit. Hey, I have a question for you too, and it's I know I'm bombarding you with this and haven't given you any prep for it, but I did notice that normally Brent crude trades above WTI. And just for the listeners, Brent is basically European prices for crude oil. WTI is called West Texas Intermediate. It's typically the price we base domestic oil off of. But during the conflict, towards the end of it, WTI ended up going above Brent. Is that because we were shipping our oil overseas, and then the price went up because it was we were no longer consuming as much domestically? I just I've not seen that very often. Do you know the reason why that happened?
Yeah, no, so that one, I'd say, I'm not too knowledgeable on,
Well,
like,
maybe since you
that.
don't know, maybe we could just touch on
We
that
can
next
table that
week.
one, but I can make
Or I
assumptions
could
on
ask
it.
chat.
Yeah, Chad, but I can make some assumptions on it, right? So the reason is, again, WTI is also, so Brent crude is the oil that's typically from the ports, right?
Mhm.
And that's the one that's shipped globally. WTI is usually taken out from around the central US and then brought to the ports, right? So you would have increased costs of taking it from the land, bringing it to the refineries in, Houston area, and then whatever changes that. This could also be related to, I don't know if you saw on the global maps, a huge uh, chain of ships going straight to Houston, right?
Yeah,
All
coming to get
around the
our
Horn
oil,
of
right?
Africa, right? Going there. So there's, again, increased demand, probably not as much supply over there, right? So these could be like the possible reasons for why WTI itself saw a bigger price increase, is because there's probably just a lot more demand than usual for uh, WTI oil.
Here's what it says, and I think you're pretty much spot on. It says, chat says, when WTI trades above Brent, it's basically the market telling you that the US crude market is tighter or more valuable locally than global crude. It's unusual, but it happens for a couple of reasons. One, US supply tightness, which with ships coming to the United States picking up our oil, that will increase demand on our oil, draw down our inventories, and cause the price to go up. Also, strong refinery demand can cause that to happen, which also makes sense because a lot of the oil that is refined in the United States does not come from the United States. So if there's not oil coming from the United States to fill our refineries, then we'll have to refine our own oil, causing the price to go up. So the
Yeah,
export dynamics, the United States is now a major crude exporter. So global demand for the United States light sweet crude is strong. Export terminals are maxed out, and arbitrage flows favor shipping US crude abroad. Arbitrage flows just means the difference between how much is coming from what we make domestically and how much is coming from abroad. So that's your answer. I think you were pretty much spot on. So you and ChatGPT, neck and neck for most intelligent human.
And for the listeners out there, yes, we do use AI for understanding certain things.
Yes, yes, absolutely. So, um, I'll add one more thing, and then I know you got a subject you want to get to today,
Mhm.
but just a couple of big winners. Oracle up 12% for the week. Um, I'm sorry. Yeah, up 12% for the week. Intel was up is up 60% for the month. That's pretty shocking. Nvidia, Microsoft, and Amazon, all big winners.
Mhm.
Sharon Williams and Home Depot, from an industrial rotation perspective. Bank of America, and then we saw Eli Lilly with their GLP-1 pill that may be coming out. I also am aware that Eli Lilly is kind of the market, potentially the market leader for retatrutide, which is what they call GLP-3, a newer version of GLP-1s that's not currently FDA approved. It may be coming out later this year. That could be really big for Eli Lilly because in the whole Maha space or the online influencer space, retatrutide has become pretty popular. And
Which is interesting.
so, or retatrutide, however they say it. So Eli may have something down the road for those people who are looking to speculate. Again, not giving advice here, just talking through what I've heard and what I've read, information that is publicly available. Go out and look at it yourself and contact your financial advisor. Big losers for the week: Netflix. Netflix was down 10% on
Yeah.
Friday. They have a big cost to be able to get their their content. But I think the bigger news was that the co-founder Reed Hastings is stepping down from the board in June, so he's been there for almost 30 years. Netflix, you probably don't know this if you're younger, but for me, I remember when Netflix launched, we would rent DVDs from them. So they would ship you
Yeah.
2 or 3 DVDs at a time, and you would send them back, and then you get more DVDs. That's how Netflix started, and so interesting to see that. Obviously, energy stocks getting slaughtered last week with the price of oil coming down. Wells Fargo had disappointing earnings, so another big loser. JPMorgan had a good top line revenue, but their interest income guidance has been reduced. Therefore, they got sold off. So those are just a few examples of both the winners and the losers. Before we move on to the subjects you have to cover, Arpit, any comments on any of those winners and losers?
No, I mean, I will talk about some of them when we move on here. But another big winner also was AMD. If you guys don't know, AMD is one of the other big AI chip players. They're kind of the, I guess you could say, the counter player to Nvidia. They had a pretty big week last week. A lot of this is because there's been bigger announcements. I believe Claude itself came out and announced that they're going to start using a lot of the MI chip series from AMD versus Nvidia's GPUs. So it shows, this is generally pretty good because you want to see overall competition. That's will make them try to have better products, all right, and
Mhm.
not just, as we call it, enshittification, where you have a really good product and then the next few products just get worse and worse and worse and worse once you're already
Well,
into it.
I think
So
the cool thing about that was you didn't see their competition sell off.
yeah,
So you saw the AMD get a big spike, but it didn't come at the expense of the other folks
yeah,
who they compete with, which tells you the market thinks there's breadth opportunity here for there to be, an expansion. Just so much money going into the artificial intelligence space. Still not real clear how that's going to be monetized, but it is certainly remains the place where growth is being driven in the markets. If you at least if you look backwards, and I got a question for you. At my house, in my home gym, as you can see behind me, there's my little rack that I try to stake fit on. But my roosters are crowing right outside the window. Can you hear them?
no,
Oh, cool. So no roosters
no
in the
worries.
podcast, and maybe whatever AI edits our podcast can pull them out if you can hear them. I just thought I'd ask because it's distracting me.
Oh no, I can't hear them that well.
Okay, so over the last couple of weeks, we talked a lot about private credit. You've
Mhm.
got a different subject you want to cover today. Why don't you start with that, and I'll add my conjecture where I see fit.
Yeah, so it's a different subject, but not really, right? It's still talking about private credit, but from a different angle, different lens. So a lot of our focus has been on the BDC companies, right? Blue Owl, Ares, Blackstone. I want to talk a little bit about from the larger financial space, which is the big fear, the contagion fear, which is about banks, right? And I was thinking about this as I was writing up my notes, and I was like, banks themselves are relatively kind of confusing. So I also take this as an opportunity for our listeners to kind of understand how banks generally kind of work, right? It's going to be very simplified, breakdown because it can get very complex pretty fast, right? But if you are somebody who's ever tried looking at your own stocks for picking, and you try doing, the Warren Buffett method of looking into the annual reports, and if you ever try pulling up a bank annual report, good luck. It's around 800 something pages of financial nonsense, right?
That is where AI comes in handy, though. You can plug it in and get a summary.
Yeah, until your cloud usage gets used up on that single file. Um, but ultimately, I'm going to try to talk about banks and why last week was actually very important for understanding kind of the guidance overall for the economy right now, right? If you're a listener, you're probably thinking about from the user side. You're right. You're probably thinking from the inflation expectations and higher cost of groceries. You might be thinking, well, the economy might not be doing that well, and y- you won't be necessarily entirely wrong from your perspective. However, it's important to kind of just start looking at the really big thing that drives the economy, and that's credit, right? Lending, right, Joe? So banks ultimately,
I'll make a comment on that, which is that the credit expansion has predicted pretty much every
yeah,
recession. I'm sorry, credit contraction has predicted pretty much every recession of my lifetime. So that could change in the future because you never know, God, the shocks that may show up. But credit expansion would indicate the economy can continue to grow because borrowing is an accelerant to growth.
yeah,
And I think that's what you're saying, right?
yeah, pretty much. And private credit is an accelerant to credit itself, right? So the
Yeah, it's
idea
more
is,
ways for people to access capital, maybe more expensive, but
yeah,
also potentially simpler for people. So it accelerates that capital throughout the
exactly.
economy in ways that you don't have to go to a big bank to get the money from them. You don't have to go to the big Bank of America, Wells Fargo, Citi, Chase, all the big daddies.
Yeah, and it's been really prevalent since the GFC, Great Financial Crisis.
Mhm.
Almost all loan growth stems from private credit because private credit is not only lending to just individual owners; it's lending to private equity, which then buys. All this growth for the last few years, you can almost attribute to massive expansion in credit, and a lot of that expansion in credit comes from private credit, right? So it's important to understand, the credit markets, and the only way to really understand what's happening there is to look at banks. And last week we had a bunch of bank earnings, right? We had Bank of America, JPMorgan, Wells Fargo, Citi, Goldman, and Morgan Stanley, Bank of New York. So a lot of information for last week, and we can derive kind of the health of the general economy from just last week's earnings and why that's really important. You can derive the health from the stock market in the next week's earnings on the 29th when a whole bunch of tech companies release. But for the economy, bank earnings are some of the most important things, right?
Right.
So I guess before I kind of I dive deep, is let me ask you, Joe. I don't know if you've analyzed bank companies.
Not recently.
What is your like? If you can tell me what you think banks do, like what is the business ultimately the business of a bank?
Yeah, well, I mean, modern banks, it's a little bit different. Modern banks, I mean, obviously they lend money. They take
Yeah.
in deposits and then they lend portions of those deposits out and earn interest income. That's kind of
Mhm.
the traditional model of the big banks, and that is what they still do. However, banks are also now integrated, extremely intertwined with the what we do for a living, or not necessarily what we do, but
That's
they have
right.
a huge financial services arm. I mean, again, Bank of America uh, uh, and Merrill Lynch are
Mhm.
connected. Merrill Lynch is a classic old school Wall Street name. It's owned by Bank of America. That came out of the Great Financial Crisis. Merrill Lynch was on the verge of failure.
JP
It was
Morgan Chase.
combined with Bank of America, and so now you have that side of the business as well, which is personal financial planning. It's all sorts of different things. It also has an investment making component, mergers and acquisitions, bringing companies public. I mean, and that's true for J.P. Morgan Chase. That used to just be Chase and J.P. Morgan separate, also
Yeah.
combined. Wells Fargo has all of those things. You have Wells Fargo Advisors. You have the banking function. But to the best of my knowledge, their primary business is lending,
Yeah.
financial services, and then investment banking for the bigger banks. That's where they make their money.
Yeah, and you hit the nail right on the head. The main business of a bank is lending, or essentially, to put it in another way, if you're an investor in a bank, you're paying the stock price or you're paying the price to essentially gain ownership of that bank's balance sheet, right? And that balance sheet is comprises entirely of loans. Okay. And you mentioned something earlier, net interest income. For those who don't know, net interest income is pretty much just the income that the banks earn from all their loans and the income that they had to pay out to all their depositors, whatever that remains, that is essentially net interest income or how much, revenue they make from the balance sheet, which is what we
So, like, let me explain it in a different way. If I sold, you know, my iPhone, if
yeah.
I made my iPhone for $700 and sold it for $1,000, I'll be making a $300 margin or profit.
Mhm.
For banking, they pay out deposits at, let's just say, 3% and then charge loans at, say, 6%. That's their margin, right? That
Yeah.
difference between what they're paying out and what they're receiving in interest from the loans that they lend. Is that a
Yeah. Pretty much.
oversimplification?
Yeah. No, that's pretty much it, right?
Yeah.
Um, Now there is one formula. Now, if you understand the formula, you understand all of banking. Okay, or not all of banking, but the general gist of how to know if your bank is good, and it's ROE, right? And it's return on equity, which is
Yeah.
ROE, or in the bank's case, tangible equity. But that gets complicated. Don't worry about that. Return on equity equals return on assets times leverage. Leverage is how we determine leverage for a bank is just simply taking their assets over their equity, right? The higher the leverage, obviously, that means you have a lot of, how would you say, multipliers to your return. So your net interest income, right? You can think that as your ROA, right? That's your return on your asset portfolio, your assets, your
Okay.
loan. If the bank has a huge asset pool, right, but they have a little bit of equity, they have a lot of leverage, right? You can think about like they just have a ton of leverage. So every percentage point increase in their net interest income, you can take that, multiply it with the leverage, and that's pretty much how much money a bank is kind of making, right? There's been a lot of comparisons to what's happening in 2008 to what's happening now in private credit, right? And the reason I dive heavily into this is because it's very important to understand the distinction, right? In 2008, that leverage number uh, was around 30 plus, right? On average, 37 to 40 for banks. Right now, it's 8 to 10. So it's heavily delevered on the financial side,
Right.
right? We also have, again, massive stress testing. So when someone comes out and says, "This is the next,"
Additional regulations that came out of the
yeah,
great financial crisis, and those are
massive
still
regulation.
most of them are still in place.
Massive regulations, and the bigger banks are probably, not probably, and I can't say guaranteed, but they're in such a position to where something like 2008 should not happen in the large retail banking space. We're talking about your Wells Fargos, your JPMorgan Chases, your Bank of Americas, right? Now,
Yeah.
there's been some thrown around names, Wells Fargo in particular, which got caught up in MFS, which was a fraud, a
Yeah.
private credit fraud, right?
Right.
And then they're also caught up in another Canadian lender that's going through some trouble. But ultimately, we are not seeing the leverage and the
Systemic
difficulty,
risk.
the
Yeah.
systemic risk that we saw in
Yeah.
2008, right? The other big thing to kind of look at to gauge systemic risk is the growth in non-accrual loans, right? What a non-accruing loan is, when a bank gives your lending out and they see that the day is 90 days delinquent, the bank takes the loan's projected net income out or any interest that they make from those loans, and they take it out of net interest income. It doesn't hit
Okay.
their right. So we look at this number as a good gauge of kind of just health of the economy. Prior to 2008, for the last few years, this was increasing. Right. You want to look at year over year growth and quarter over quarter growth. This was increasing rapidly from 2006, 2007 to 2008. Not seeing that here. It's up 6.6 around 6% year over year, but it's actually down 0.8% quarter over quarter. So you're not seeing a rapid growth in non-accrual loans in the major banks. So again, hinting at the fact that there is not major systemic weakness in credit markets, right?
Good.
Private credit
Yeah, that's a
itself,
good sign. That's a good sign for there not being a
mhm,
major recession or even probably a minor one. I mean, I guess you could have a energy shock induced recession where
good. So
consumption drops dramatically because of energy
yeah,
prices, but I think outside of that, what I'm hearing from you is Maybe that the private credit scare is a bit overblown.
Potentially, right? Now, here's
Yeah.
the other big point. These guys all got asked questions about private credit. What's their private credit exposure? Wells Fargo is around 30 billion, Citi's around 22, JPMorgan around 50 billion in private credit exposure. It's a lot of money, right?
Yes.
JPMorgan's loan portfolio is 1.5 trillion. So it's really not that.
It's like 2.5% of their overall. Is that
Yeah,
right?
yeah.
2.5% of their overall loan portfolio. That's
Loan portfolio. So
yeah, not
they
very
have
big.
private credit exposure, obviously,
Mhm.
and they shouldn't. It is worrying when these private credit losses happen. But it's really when you're looking at it on a bank level, the economy does look fine. Now,
Yeah.
on a consumer level, we are experiencing a K-shaped economy. The economy does not look fine,
Right. Well, if
right?
you're
And so one
especially if you're
doesn't
at the
void
middle or
the other.
bottom.
Yeah, one doesn't void the other. And it's and if you're struggling out there, you can't say, "Oh, well, banks are doing good, so it must be all right," right? Um,
Yeah,
however,
try to get a loan if you don't have any income or you have very little
yeah,
income.
right. And so it's a very strange thing to where you're seeing relatively healthy credit markets, weakening in private credit, so it seems, right? Um, and then a weakening consumer base. We still derive the fact that the economy itself is still fine because again, private credit itself, credit growth, credit health is that important. Now, there are counter arguments to this, right? The counter argument is again how transparent are the lending portfolios. Now, on the bigger banks, it is actually fairly transparent. They can't really hide that well anymore.
Right.
In private credit markets, when it comes to Blue Owl, Blackstone, all these guys, they're fairly opaque, right? But if there is a major private credit issue, it's probably just going to be located to the BDC company and not a
Right.
systemic risk. And probably if you want to own banks, actually, at that point, because JP Morgan and these guys are probably going to buy up all these BDCs for pennies
For
on the
cheap.
dollar. We
Yep.
saw PIMCO buy up $400 million worth of private credit loans from Blue Owl,
Right. Yeah. They
right?
got them.
So
They
that's
got them
probably
on
going to see
discount. Right.
we're going to see deterioration in private credit, and then some bigger bank come in and buy them out.
Yeah. That's how that world works, and that is a good time to potentially buy banks. I'd point out something also that if you're a dividend investor, a lot of times big banks are some of the better plays there. They have a long history of increasing their dividends and returning capital to their investors that way. And again, because of the predictability
Mhm.
of their cash flow from net interest income, there's a default rate. How many of those loans are not going to get paid back? It's kind of baked into the cake, and as long as they stay within their expectations for those default rates, there's a high degree of predictability in the financial services world.
Yeah.
But that's a good the segue. I do want to touch on one last thing before we close, which we did the last episode on Thursday of the previous week. The next day, the headline CPI came out. It was up 3.3% relative
Yeah.
to the 2.4 from the month before. That's kind of what we were talking about with the energy prices. That's a quick burst into CPI. We should see that again next month, and then hopefully that begins to fade as the year goes along. Because if we keep inflation mid threes, fours, it's going to start really putting a pinch on the middle and lower consumer. I've already heard it about it. My
Mhm.
son drives a Toyota Tundra, a used Toyota Tundra. My youngest son, he's like, "Dad, it was $125 to put my car in." He said, "That's not right." I was like, "Yeah, that's what happens when you're paying 425 for gas." And so, just wanted to make mention of that inflation move. I thought that was important. I think it, additionally, for people who are on the lower end of the scale, we saw a 2.7% increase in food costs, which has just been continuously
Yeah.
moving up. Price of groceries up about 4.5% year over year at this point. I'm sorry, from last year to this year. Energy prices obviously spiked, but also electricity prices, which is something that affects us in our every monthly bill because natural gas prices have remained elevated. We have seen or electricity prices about 11.6% higher than they were a year ago. So
We're not even in summer yet.
yeah, we're not even to the hot. I mean, where we live in Texas, yes, very hot. Up north, they are. That's probably like their better months for electric bills because they
Yeah.
don't have to run their furnaces. But something to keep an eye on, no doubt. I did forget to mention my shirt. I'm going to try to wear some fun shirts every time, but this is George Washington and Jesus having a little conversation. I don't really have a meaning for it. You guys can put whatever meaning on it you want, but it is fun. And so I'm scouring the internet for future shows so I can keep you all entertained with my shirts, except for when I have to shoot the show from the office when I'm actually working, and then I'll be wearing something boring.
Like, rip it off like Superman, you know?
Yeah. Hurrah! But, yeah, we've loved bringing the show to you today. We're looking forward to coming back at you next week where we will look and see what the market does since we're not allowed to say what we think that anymore. Me and Arpit will write it down and we'll talk about it on the next show as soon as we stop this recording so we can keep the score going. As of right now, I'm 2-1. You are one
I'm
and
running
two.
too. Yeah, 1
That's
and
your
2,
first win. So
yeah.
I'm still ahead of the whiz kid over here. So we're looking forward to come back at you next week. Thanks for tuning in.
Alright, take care, y'all.